Hello and welcome to the big story. Down over 50% in a year and up 30% in just 1 month. Well, that's the BSE Real Estate Index for you in 2011 and 2012. The reasons for last year's fall are all well known. But what has led to this massive recovery in real estate stocks? Is there a fundamental change on the ground? Or is this just about investors looking for value in beaten down stocks? Let's try and decipher that today for you. Joining us to discuss this is a very elite panel here with me. Pranay Vakil, Chairman Knight Frank, Bharat Modi, CFO Uptown, and Param Desai joins us. He's a senior research analyst of institutional equities at Nirmal Bang. But before we go to our experts, let's just get a sense of what's really happening on the ground as far as statistics go. Sameepa Shetty and Ruth Saldana, both here, who've studied the numbers to understand this dramatic recovery. Sameepa, you go us.
Vivek, first let's take a look at the big fall. The BSE Realty Index in 2011 was down about 52%. The biggest loser, HDIL, down about 72%. And then let's track the trajectory of the big recovery that we are seeing currently. The index is higher by nearly 30%. If you see this, the biggest gainer is up nearly 53%. But is there anything fundamental which is really driving this rally upwards? If you believe experts, then nothing really has changed on the ground. In fact, there were no significant launches in the third quarter. The debt burden of many of these companies still remains extremely high. You also have the asset monetization that many of these companies, including DLF, have been practicing, which is still very difficult to execute on the ground. So what really has changed there? Nothing seems to have. In fact, if you look at the quarterly performance that some of these companies have delivered, they're shocking to say the least. India Bulls Realty, profits are down nearly 45%, but how has the stock reacted? The stock has actually gained. It's up around 48% this year. It was down 66% the last year. So it has almost recovered most of its losses from last year. What hit the profits? Interest costs, which were up 27 times. You also have another real estate player right here in Mumbai, Oberoi. In fact, this is the only company which managed to increase prices in third quarter. Their profits halved right there. How has the stock reacted? The stock has gained. The stock is up 17%. It was down 19% last year. So once again, managing to recover most of those losses. And finally, you have another important counter, which has reported its numbers. You've got Godrej Properties, which has performed really well in the last year. Again, in the third quarter, you had profits higher by 85%. The stock was lower just by 2% last year. It's a high by 9%. This is a look at the stock performance for those companies which have delivered their numbers just yet. And you can see the dichotomy. Although the results were lower, the stocks have been gaining this year. And the dichotomy continues when you talk about the demand and pricing sort of situation. In fact, the sales in Mumbai real estate or Mumbai residential space have dipped to near 3-year lows. On a quarter-on-quarter basis, they lost 17%. This is according to Liaisons for us. You also have the unsold inventory, which is at a 44-month high. Experts believe that for any healthy market, the unsold inventory should not exceed 8 months. Now, those are the kind of figures that you're seeing in terms of demand. But what about price? It hasn't actually fallen. In fact, it has risen to a record high of about 10,558 per square feet for the city of Mumbai. The weighted average cost is what I'm referring to at this point in time. So the dichotomy for the real estate sector continues, and experts believe there are certain triggers yet to come which might actually take these stocks higher in the new year. The expected rate cuts from the RBI, that is expected to boost sentiment and demand. Analysts also believe that because a lot of clarity has emerged on the regulatory front, you might see a lot more launches in the first quarter of the coming fiscal. And what are these regulatory clarities that have emerged? You had the DCR norms which were changed, some clarity emerging on the rehabilitation slum redevelopment project of Dharavi. It was expected to boost stocks like HDIL and the likes. So all of these triggers are expected to take these stocks higher as we head into the next quarter.
All right, Sameepa, thanks very much for that. Ruth, let's come across to you now. You tell us what's really going on as far as sales are concerned on the ground.
Well, the experts say that the dichotomy of high pricing and low demand is likely to continue in many major markets, especially for the first half of 2012. Now, the analysts say that several factors have contributed to this, including low availability of funds for developers to construct, high construction costs, especially labor and raw material costs, high interest rates, and unique to the Mumbai market, a virtual drying up of approvals, leading to a standstill in new projects. Now, most of these factors are likely to remain unchanged in the first half of this year, with the exception of one, which is the interest rates. With the RBI appearing to change its high interest rate stance, the buyer sentiment has definitely improved, leading to an uptick in sales from the month of December 2012. This is most visible in cities like Bangalore and the Gurgaon part of the Delhi NCR, where demand is showing slightly higher. However, for markets like Mumbai and Noida, though a slight uptick is visible, the stress on the sector is likely to remain for the first half. Analysts, however, are uniformly bullish on the long-term real estate story and believe that despite the short-term blips, the sector will pick up. As demand has not slowed or vanished, it is merely waiting for a few factors to change before returning.
All right. Thanks very much, both Sameepa and Ruth, for getting us that perspective. Now, let's go across to our panel of experts. Bharat and Pranay, I couldn't but help notice you all smile several times during those two stories. What's really going on? Let me come to you first. I mean, you have a situation where sales are not doing well, prices haven't come off, yet stocks are on fire. What's really happening?
Okay, you want a one-word answer?
Yes.
Everybody is confused.
Confused. Including
the buyer
market.
is confused because he's expecting the prices to go down. The developer is confused because the regulations keep on changing and he doesn't know where he stands, particularly SEZ and those kind of regulations. The lender is confused because he knows that even by reduction of price, the developers are not able to jack up their sales. So, I mean, everyone, all the stakeholders in the industry are quite confused as to what is happening, where is it going, and where will it go in 2012 compared to 2011. I think that's where we stand.
Bharat, this is one sector where it's always been who blinks first, right? I mean, we always hear about the fact, or rather, we've heard about this fact for the last 2 years now. Lending has, become far more tighter. Raising money from a real estate company's point of view has become far more difficult. Interest rates on a consumer have only increased. Yet, most developers seem to have held on to rates or prices. In that backdrop, do you see a situation at all where, we just heard the fact that sales are at 3-year lows as far as even Mumbai is concerned, but prices aren't coming off? What is the market getting so bullish about?
I mean, frankly, if you really ask me on the stock exchange side, stock market side, I don't want to comment on that because stock markets have always defied all kinds of logics.
So when you say don't want to comment,
I mean,
it
I don't
means
understand.
that you don't understand.
I don't understand also, and
That's
I don't
what
want to
you're
comment
saying.
on
You
that.
don't, you can't justify it. Let's put it that way.
Even the sharp fall was also not justified, and even this kind of a sharp recovery. I mean, that is what we had seen in 2008-9. Within 6 months,
That's an important point you're making. You're saying
yeah.
even the fall was not justified.
No, even in the 2000s, if you really look at it, the sharp recovery of 2009, ideally that recovery, according to me, was unwarranted and it is not there. It was just on the backdrop of a lot of money chasing, a lot of projects, etc. That is why the prices had gone up. Same way for the stock market recovery. Well, it's just demand and supply and funds, funding. If a lot of and Indian stock markets, the depth is very low. We don't have the kind of depth which you see overseas markets. So this is just a case of just 5 billion, 10 billion FII funds coming in and just ramping up. And this, historically, if you look at it, the real estate and the construction industry would only lead to the recovery of the economy because it supports so many industries, steel, cement, labor, a lot of ancillaries, etc. So that is the only way. You get in at a good price, decent price, and wait for it to appreciate. According to me, the India story is still intact, though there are a lot of blips, 2G and this and that. A lot of things are happening, but overall, according to me, over a period of time, this is going to lead to a lot of transparency in the way we operate, both in the economy as well as in the sector. So the foreign players and the investors would definitely feel more comfortable than what they are now, even though, a lot of funds have come in the sector, even though a lot of opaqueness was there in the way things were happening. So from now on, according to me, it can only be upward trend, though next 6 to 12 months would determine the pace at which it can happen.
Okay. Let me get a stock market view here. Param, you've heard both Bharat and you've heard Pranay as well outlining what they think is really going on the ground. But from a market point of view, how would you explain the sudden bullishness? Because the question that I posed to them as well, your input costs have gone up, your liquidity hasn't gotten any better, you're sitting on assets while some players have been able to flog them off to repay their debt, but that still remains a very small part of the overall debt issue. You've just heard some of the statistics, which of course you would be tracking far more closely. It's not as if they've delivered great results, but yet there seems to be a sense of bullishness around this sector all over again in the market.
See, we are not gung-ho about the current rally. If you see the BSE Realty Index has broadly underperformed the broader indices over the last 1 year, and we expect that trend to continue in the medium term. And the key reason is basically the weak demand, as well as the basically debt is the major overhang on the sector. If you see, most of the companies are behind the schedule of the debt reduction plan. Whatever cash flow they are generating from the core operations are basically going out for the interest repayment and the anticipating. Plus, if you see the third quarter, in spite of the festive season, new launches has remained pretty much subdued across all the companies. The prices have remained pretty much firm. They are not going down as such. So we believe the Q4 being the last financial year, the RBI has been very cautious to lend the money to the real estate sector. So it will be interesting to see whether they would be rolling over the debt for these companies. Because if the rollover doesn't happen for most of these developers, then we might see the prices coming down. And it will be overall good for the sector per se, as the volume recovery will happen, which seems to be quite muted as of now. So we are not so gung-ho about the current rally, and we believe one will get a good entry point at this counter.
Bharat, you see prices coming down?
Not much, according to me, because there is no supply. I mean, the demand is there, already there. Because of the limbo on the approval side for the last 12-15 months, no fresh approvals have come, and there is a lag between construction, approvals, construction and delivery, so that ready-made stock is not going to be there as expected over a period of time. So I don't see much fall in the price. Maybe, generally whenever a buyer goes also, the developer is happy to give a discount of 8%, 10%, 15%, depending on the negotiating power of the buyer and the position that the developer is in at that point of time. But across the board, slashing of prices, according to me, it's not going to happen.
It's a very important point Bharat makes, and isn't that, Pranay, the story really of our real estate sector, that while over the last few years we've tried everything possible on the demand side to attack it, on the supply side little has been done. And approvals probably, and that's what developers tell me, have only become worse. You've got even more approvals now to go through, time taken to get projects off the block are even more, and that eventually perhaps is what keeps prices where they are, because on the demand side your input cost has gone up, so you obviously should ideally be kind of worried about how you're going to really boost your sales unless and until you don't cut a bit. At the same time, your interest rate story hasn't yet changed. Hopefully it will very soon. Yeah. But at the same time, you're able to keep those rates, and that's largely probably because of the fact that we've got a supply situation where approvals are taking far longer. Is that really the story which reflects even in the market?
There are two main reasons why the prices are not coming down. If you take 50% of the developers, they are in joint venture with a landowner. Now, all those landowners, historic cost of the land is very, very small. It's minuscule. Take a textile mill, for example. Owner of a textile mill entering into a joint venture with a developer. He hasn't bought the textile mill now. It was something which he inherited, through generations. Now, 70% of your sale price consists of land cost. You haven't paid for that land. Imagine your ability to hold on to the stock when you haven't incurred that 70% cost. It is possible that the developer has given some advance. It is possible that there is some kind of an arrangement by which there is pressure on the developer to develop fast enough. But the main reason is that you haven't paid for the land. All right? That's very important. Secondly, when a developer is involved in a larger project where he's developed something and he's in the process of developing something else, right? He cannot afford to reduce the price. It will reflect on what he has already sold. I don't know whether you heard this story about two developers getting gheravod, and I'm using that term very loosely, where the existing buyers gheravod those developers to say that, look, we are going to ask for this reduction. We bought it at 9,000 rupees a square feet. You are now selling at 7,000 rupees a square feet. We are not going to pay you the balance. It's a huge problem for a developer.
But are they under stress?
They
Are they lining up outside your office to say, help me sell my assets? Is that a trend you're seeing?
Yes, they want to come up with out-of-box thinking. What they want to do is not across the board reduce the price. But if you're a buyer approaching them, he'll say, hey, get 2 more, and if you buy 3 flats, I'll give you 15%.
What about sale of assets, Pranay?
I think the non-core assets are a big, big issue. A lot of developers are getting out of it.
We saw a lot of them going into the hospitality space. We saw a lot of them going into you know, the SEZ space and all that is over, according to you?
Well, you've seen the number of licenses that have been returned to the government on the SEZ front, right? So people are not very gung-ho about doing any of the things which involve a large term commitment. They want a short-term commitment, something which you get in and get out in 3-5 years. But if it's something that involves a 10-year scenario, they're not able to see the 10 years. And therefore, they are not willing to commit to that. SEZ is such one instance. Look at what happened to IT. To date, people don't know whether that particular provision in the Income Tax Act is going to be extended or not. How do you make commitment, tell me? How do you create an asset? So
Bharat,
there's one.
Yeah, sorry. Bharat, how stressed are real estate companies when you talk to your colleagues across the sector?
I mean, there is definitely a stress, no doubt on that. A lot of commitments are there for repayments, etc., servicing of debt burdens, etc., etc. But at the same time, there are options still available, albeit at a cost, due to which...
But you think they'll survive this?
Yeah, I mean, see, it's a question of taking a call on, retiring less costlier debt with slightly higher cost debt, and tiding over the period of 6 to 12 months, within which time, if a call is there that maybe after 12 months I will get, instead of 12,000 that I'm selling currently, or with, the price point at which it can sell, and if I expect 16,000, 17,000, and I reduce the differential of the interest costs, then I will take a call and then, push back the sale. And at the same time, as he rightly said, if I had sold earlier at, 14,000, then I cannot sell at 12,000 for sure. So that's again, it's a different constraint which one has to look into and take a call.
Param, come into this. We've heard 2-3 interesting perspectives out here. One is, of course, the fact that, look, you've got a supply side issue going on out there in the sector. So even though there are headwinds on the demand side, but because the supply is so constricted, you probably will not see prices coming down. In that backdrop, do you think that this rally perhaps could continue? We also heard Bharat here mention the fact that there is a liquidity, this is a liquidity-driven kind of a rally, and the fact is he feels that in the first place they had no reason to have been hammered down the way they were. So are these the two factors as far as the stock market is concerned that's playing out? Okay, I think we've got a bit of an audio glitch out there. Yes, Pranay, you were saying something. Yes.
There's one thing to be kind of taken note of all over the world. When things begin to look good, what are the scripts that go up first? It's always the real estate.
Okay.
And when things begin to look bad, the real estate stocks are the first one to crash. Now, what we've been seeing recently is possibly the effect of a feel-good factor. And the feel-good factor has mainly come from the CRR relaxation.
But that's sentiment, Pranay. That doesn't,
Absolutely.
That's not really reality, isn't it?
Absolutely.
It's always sentiments.
But isn't the stock market driven by sentiment? Right? And if it is driven by sentiment, the real estate stocks are the first one to react. And that's exactly what
So we're saying this is more a sentiment-driven rally, and the reality on the ground is very different. Bharat, would you agree to that?
Yeah, it's still not changed. I mean, it'll take at least 6 to 12 months minimum for things to start moving, especially the Bombay market, because the approval scenario, the new DCR has just been published. People still don't know what is the impact of that. People are studying. There is no clarity on how the BMC authority, MCGM authorities would view the proposals when given under the new regulations. So that time frame of 6 months to 12 months would be there at least to have a sense on when the new projects would be launched. And that supply, when it comes, the advance, the booking side, that is the first time it will happen. So to my mind, at least 6 to 12 months now are there for the things to convert back into something real. This is, as Pranay Bhai rightly said, this is nothing but perception. People, I think, were too impatient sitting on the funds,
Or
and
just
they had
tired.
to invest, and too tired. And that
So is it a better idea to go out to London and buy property there? If what Bharat is saying, 6 to 12 months, nothing's going to change in Bombay?
Yeah, but let me tell you something else. How many developers fix their price with reference to the cost. None of them do. They fix the price on the basis of what the traffic can bear, how much they can get. So if there is an inflation in the cost, if there is an increase in interest, yes, they are affected. I'm not saying no, right? But that's such a small component normally of a high value sale, and I'm not talking of affordable housing, I'm talking about the luxury housing or the mid segment, right? I don't think it is driven by cost necessarily. Yes, the cost can go up. Service taxes come. There's a High Court judgment now saying that you will have to pay service tax when you're selling under construction, 2.5%. Yeah, I mean, every opportunity to pass on that to the buyer will be done. But the prices are invariably determined with reference to what the market can take and not necessarily the costing, excepting for the affordable housing.
All right, we leave it there, gentlemen. Thank you very much, both of you, for joining us. Thanks also very much, Param, for coming by. We wind up this edition of The Big Story with the special focus on the real estate sector. As you've heard our experts, well, from a consumer's point of view, not very good news. You can forget about any fall in prices in the next 6 to 12 months. But as far as the industry is concerned, headwinds still out there, but supply constraints perhaps ensuring that the prices stay where they are. Sentiment seems to be driving it more than fundamentals at this point of time. Thanks very much once again, both of you, for coming by. We take a quick break. We come back with Market Guru.